Many thanks for you all coming to this workshop, and I do want to make it a bit more workshop-like, although the physical venue is not ideal for how this should normally be conducted. But let's see how it goes. I have here a quote from somebody who I think is a very good mainstream economist. He is of this, New Keynesian synthesis variant, but he's also a very understanding and innovative person in the sense he lets himself be guided by what the policy issues of the day are, and of course he works a lot on monetary integration, and at the same time, and the theory then follows. What I'm going to do is, if I want to build a bridge to what Eckhard Hein has done this morning and a little discussion we had, I do think it is a problem, and I have been a heterodox economist myself, if you always confront the mainstream with the foundational questions, instead of showing that the way they analyze something doesn't help us to understand the world. Then you can convince people like Jean Pisani-Ferry that perhaps then our theory has to change. And that would be the way of how I recommend to you to do it. This is what I've learned after a long time trying the other way around, and that wasn't so successful. So let's briefly read this, and then I give you a chance to reflect on this among yourself, talk to somebody next to you, or just make a few notes if you prefer. So what he says is, the euro, the only transnational currency issued and managed by a single common institution, the ECB, was the last utopia of the 20th century. It was a complete economic and monetary revolution, a currency that did not rely on a state or on a commodity, gold. There were reasons to be skeptical, economists, but Europeans decided to push through with the project nonetheless. And what I want you to do now is discuss with your neighbors, or just your one neighbor, of what you think of this quote. Do you agree? Does Jean Pisani-Ferry nail the problem, or in fact the achievement that the euro area is in your view? And take some notes, because at the end, instead of a conclusion, I will come back to this quote to position myself towards it. Okay? I give you 3, 4, 5 minutes and say hello to somebody. I'll take it as a sign that you found the quote interesting. Let me therefore give you a quick overview of how we're doing this whole workshop. So I'll give you now my critique of mainstream theories of monetary integration. I think the theory of optimum currency areas can be read as a political economy theory too. If you want, we can go into that in the Q&A. And my whole point is not, political economy is better because you can't do economics in and of its own. Of course you can. It's a proud discipline, and for good reason, just like political science is a proud discipline and for good reasons. I happen to be a political economist, and let's put it, it's not by coincidence that you look at European integration as a political economist, because after all, the whole project is one where you try to achieve political ends by economic means, right? Economic integration is meant to spill over into polity formation. So there is a reason in this case, but at the same time, I think one can analyze European integration through an purely economic lens and through a purely political lens. So this is totally not my point. I take first the theory of optimum currency areas. This was the only thing we had when that was starting to be a discussion. You know, that is Mandel, 1961, and McKinnon and all these people. Then varieties of capitalism, or rather the growth models, the dynamic variant, and an analysis that the euro area has combined incompatible growth models. Then we discuss this 20 minutes. I give you a chance to say, have I missed a point of critique, or do you not share my critique of this? And then I give you my alternative, this book that Jan has kindly mentioned, what I call the political economy of monetary solidarity. I will argue that there is a political economic paradox of diversity. The previous two always assume that basically you have to be similar as political economies if you want to get together. And this is something that is really my point of departure, where I say no. And then try to analyze what has happened over those last 20 years and recently with another big wave of reforms, that I see an evolving system of reinsurance evolving in the euro area. And we have another 20 minutes or so to discuss this. Okay? You have a license to interrupt any time if there's something I mentioned that you didn't understand, or I use an acronym, which I hope I don't. Please just raise your hand. So why are these existing theories of monetary integration? I should say the traditional theory, because there's a non-traditional one that actually has conceded that diversity may be a good thing if you have perfectly functioning financial markets, and so that is the little snack. Traditional OCA theory, what's the problem? I'm not giving you an undergraduate introduction to OCA theory. I do assume that you have heard of this a little bit. The first thing to notice is always, and it almost is always forgotten, is the perspective is really that of a member state, a prospective member state that thinks, should I join, in the sense of, should I irrevocably, that's a quote from Mandel, 1961, irrevocably fix the exchange rate. Never mind that we noticed that exchanges cannot be irrevocably fixed. You will have at some point a speculative attack and the whole thing goes up in flames. But this was really the question. Should I join such an exchange rate fixing arrangement? Not what the Europeans wanted to do, right? It also assumes that exchange rates, and this is repeated and repeated these days. Paul Krugman was one of them. In a Brookings paper of 2013, there are reliable adjustment mechanisms that then need to be replaced if you fix them. So, and then there were the McKinnons and everybody. Primarily, you need labor market mobility and the ability for internal devaluation, i.e. flexibility of wages. I'm always surprised that one says flexibility of nominal and real wages. If nominal wages are very flexible and prices are flexible, then the real wage is kind of determined and may actually not be flexible enough. That was an old problem that Keynes discussed. Last, and this is, if you will, an empirical argument, in that we share a certain diagnosis now, at least, after this whole nonsense of this was all a Greek crisis in the sense of fiscal indiscipline was the problem. We all knew that this was not the problem. The problem was that it was a financial crisis that then had a phase of a sovereign debt crisis, to which I come. What this theory must assume, if you say the optimum, the OCA theory can explain why we had the crisis, the euro area crisis, must treat this financial crisis as an exogenous shock. It came out of nowhere. US, probably, US subprime markets, and it was country specific. It was only a Southern European plus Ireland crisis. Well, if you believe that, then perhaps OCA theory is a good theory. But even mainstream economists, let alone those who have a bit of a sideway into economics, would really believe this anymore. Let me just briefly show you why it was a financial market crisis, and it was not the first one. So first, the blue line is the number of countries that are for a quarter. So this is about 40 rich, i.e. OECD-type countries between 1970 and 2010. It's an ECB working paper that has done a database number of countries with the respective crisis, like a banking crisis, a currency crisis, and you will see a sovereign debt crisis, and how many of the countries spend a quarter of a year in that type of crisis. And then so the blue is banking crisis, The light gray is a currency crisis, and then the black is a sovereign debt crisis, which we had a few when Eastern Europe, that the wall came down. Then we had that here, basically. There was a bit of a rise. Now, when did this blue line go up like this? Well, there is a reason. There was a big bang, the official start of a wave of liberalization since the mid-1980s, and guess what happened? They couldn't deal with all the risks that you suddenly could load on your books, leveraging, but also, of course, since the 70s, foreign exchange risks. The Maastricht Treaty and the that there were referenda that went against joining in Denmark and so on, and a very tight referendum in France triggered an ERM, exchange rate mechanism crisis, that cost quite a few banks their existence. What this working paper really tries to find out is really what can we use as an indicator for more crises? What is an early crisis indicator? And they find that banking crises are. Banking crises predict currency crisis and sovereign debt crisis in almost all the cases they look at, and it's not the other way around. So in a Granger causality way, banking crisis trigger the other two types of crisis. That itself is again my point. This was not a sovereign debt crisis at the start, and it is actually a crisis we knew before. And of course, there in the back, we have then the crisis that is the 2008-2009 crisis. The other is that it wasn't an idiosyncratic shock, as OCA theory always pretends. It's asymmetric, and it's when we have too much of them, then we also shouldn't do it because we don't have this wonderful exchange rate anymore. We had the onslaught of these crises came when exchanges were flexibilized, when everybody still had exchange rates, right? Exchange rates are not an adjustment mechanism. They take away a degree of freedom from your economic policy. They have to be stabilized. They are not stabilizers. And that's even more true if you're Barbara Fitz and look at all this, emerging markets. What I just want to show with this is evidence that we have that this is one, pre-2008, one standard deviation above the mean. So if it's that, then these are all common shocks. We had them before the US recession during the Gulf War. Actually, the ERM crisis doesn't figure so strongly, but then the Black Friday and the Latin American debt crisis was a bit of an... But since then, we had really, in this, the global financial crisis, had a co-movement of output 4 times larger than any previous crisis. So this was a truly global crisis because basically the rich countries of this world were all involved in it while the poorer ones were not. And that created this spike. Just to say, it was not, this is not the crisis that OCA theory has in mind. Such a common crisis, your exchange rate help you nothing. That is my whole point. And this is probably the kind of financial crisis that we see more in the future. Now let me go to the incompatible growth regimes. I take Johnson and Reagan because they have shown this most clearly what many of those of that school have said. You know, it starts with Hall and Soskis and has today many prominent representatives. Lucia Baccaro is one, Jonas Pontusson, and so on. So the diagnosis is here, well, this whole euro area set up a policy regime in which the rich north feeds on the growth in the south, the consumption-driven growth in the south, through these current account imbalances. They thought this is very clever because then we don't have any more these currency crises by which our rich nations' northern currencies then revalue, and that undermines our export surplus position and so on. So it was all a clever conspiracy of the Germans, basically. Now, the first thing that you notice here, and the south is here, of course, the red line, and the blue is the northern surpluses, so the trade balance, the current account balance, in fact, as percentage of GDP, is here on the vertical axis. What you first see is that that this goes apart, starts in the mid-90s. It doesn't start with the beginning of the euro area. Now you can say, well, yeah, because this was phased in since 1992, we have the Maastricht Treaty, and then they all prepared for it. Perhaps. But when you then do, and it's just a simple correlation I did in my book, you have here the northern current account balances and here the southern current account balances. And then you just have a simple regression. You see that from 1980 to 98, so shortly before we introduced the euro officially, there was indeed a positive relation with them that totally broke down afterwards from 1998 to 2015. In other words, if anything, the positive correlation was no longer held when the euro was introduced. And this is what you saw in the earlier graph, of course, here by this moving apart. Where does this come from? The north actually stably plateaus off while the south goes very deep. Well, unfortunately, not for a very long time, because it requires to look at confidential firm data. The ECB has done a study where it looks at the external trade balance and the debt position, which doesn't interest me at the moment, in the mid-2000s, and looks at where do countries actually have their total deficit surplus, their trade balance, and what of that is intra-euro area, and how does that accumulate over time. What you see here, this diagnosis of the north feeds on the south, feeds on the growth, the consumption-led growth of the south, is only true for two countries that fit this image, and that's Belgium, which has a higher intra-euro area surplus than it has in total, and the Netherlands, actually more extreme even, with 19.5% intra and 7%. Germany and others like even more extreme, Austria and Finland have actually, Austria used to be also an export surplus country. Here it's in a slight minus, but it has a much higher minus intra, and so does Finland, that has a surplus overall and a slight deficit inside the euro area. So these two countries should certainly be exonerated, if you think. Even Germany has its big surplus, and it is a big surplus because Germany is a huge country, much smaller inside the euro area. And what this simply means, what has happened, and that made this correlation go another way, is that the BRICS, and in particularly China, came on the market almost at the same time as we introduced the euro. And in particular for Southern European countries, this was a massive third market, third country competition that made them look then suddenly quite, as huge current account deficit countries. They lost in a competition with emerging markets. And it is true that from that, and Germany is there the main beneficiary, it meant an expanding market, is particular for capital goods for Germany, where it has its competitive specialization, and competition in terms of crowding out competition for Southern Europe, because they are in the same production like light industry or things like that. Two, and this is my last slide before I now break up and let us discuss. There are two political economic puzzles for this existing literature that I'm asking, because I'm saying, if you say this was all a kind of conspiracy and we should have only let basically Northern Europe do a currency union and Southern Europe do a currency union. How can you explain that a very diverse set of established nation states gave up their national currencies? Was there no good reason for this? If you think that the exchange rate is a good adjustment mechanism as well, then it was patently crazy to give it up. How would the EU hope to make it work without the budgetary union, without something that can replace this wonderful exchange rate that we fixed? What makes you aware of this is existing theories of monetary integration see diversity only as a problem. And that should surprise us even as mainstream economists. Because even when we trade with each other, we do it because you can produce something comparatively better than I can. And therefore we trade with each other. We are not trading with each other when we are all the same. We are trade with each other because we have some differences. And if you think like me, I have also as an interest in my research welfare states, then you think immediately insurance. Well, insurance, risk sharing is always easier if you are diverse. You don't want to have all the same risk profiles because then there's a big likelihood that we have a common shock to the risk pool and then we cannot insure each other or only through debt mechanisms with our future better off fate, destiny that some of us have or with the future generation, right? So a diverse risk pool is a good insurance pool because it's unlikely that we're all affected at the same time and then the lucky ones can help those who were unlucky. So it's in a way, economists should always have been very surprised. And actually one Chicago economist once wrote a paper that is a good paper, that the problem approach to exchange rates. And of course made total fun of Mandel, who, as you know, in the 70s has himself distanced himself from that theory. That's forgotten, but that's what it is. How could the EU hope to make it work without a budgetary union? Well, I think there was a bit of a view, and OCA theory would agree with you, the single market, especially the 4 free movements rights, were meant to work that magic. That when one country is over a country is hit by a shock, then of course the laborers can just pack up and go with their children and spouse to another country, find another school for the kids and all that, right? You see immediately where the problem is. But perhaps capital movement can do this. Except that we know that capital movements are very pro-cyclical and reinforce and amplify unequal growth processes. We have to think of how can a union like this, that has in principle a diverse risk pool that is to its advantage, make that politically happen. And this sentence, what I just say, is also my link to the theme of this conference, the socio-ecological transition. We somehow need to find ways of making what is economically sensible also political palatable. And this is not to say politics is always the break and is always not doing the right thing. I think politicians, I have a full respect for politics. It has to represent very diverse interests and needs, and therefore it does not necessarily to go for what the benevolent dictator could tell us is the best solution for the collective as a whole. They will represent the idiosyncratic views of others. So now I would like you to comment, ask your questions, critique of my critique, and I will pay a little bit of attention to time and then go to my next part. We always have to wait for the mic because this is recorded. And if students ask questions first, then I will privilege you, but if not, then the first question, are you a student? I just want to give a chance to have those of you who would like, I know it's always a bit intimidating first, but please, then go ahead. They are too shy still.
Sorry, I didn't hear your last comment about students. As far as I understood, you said that Southern European countries lost their competitiveness, or they started to give wider current account deficit because of China's entrance of world trade, or the Euro's introduction and China's introduction overlap. Could you please elaborate this point a little bit more? Are there... Oh, okay. Thank you.
I will. No, you have a good point. I mean, I'm not saying current account deficits are triggered by, real market competition. There needs also to be an aggregate demand element to this. And in that respect, of course, the low interest rates for Southern Europe, especially, so their interest rates converged more downwards than those of the North that actually in the case of, that converged all downwards, but much less, say, for Germany, created a boom in housing markets, created a boom in consumption and so on, just as you would expect. But this was not then that clever, by design, a clever conspiracy of the North then to get all that extra growth for themselves. It was then, in addition, a competition from BRICS, and in particular China, that led to a deficit that was extra euro area more than intra-euro area, although they also had intra-euro area deficits. That's all I'm saying here, because I think it is important, first of all, for this whole image, the South is just inherently, structurally a consumer-driven, they have consumer-driven economies. Why? I don't believe in any of this. They have industries, they have exports, as we now see, some switched extremely fast to export-led growth and so on. And the political fallout from that kind of portrait is quite negative, because then there's always this self-righteous sitting on the high horse and saying, well, we are competitive and we are the producers and they are just the consumers. Which is why this is a point that I try to make also with students, that it is a normal boom that was driven from a very low interest rate that could have been, and I mean, I do say that, actually the Spanish central bank knew it. The Spanish central bank almost invented macroprudential instruments in the late 90s because they saw that ever since they were part of the Maastricht process, their credit growth was about 15%. They could see that this is leading into a bubble, and were introducing macroprudential, so capital buffers that banks had to put up. But then the government at some point said, you central bank, because if you then restrain the credit growth from Spanish banks, well, guess who filled the gap? German banks, French banks, Portuguese banks. And so, of course, the banking industry in Spain was not happy, and the government gave in to their demands because they said, you're only just crunching the business of Spanish banks while we still have the bubble problem because other banks fill it. And so they gave up on this in the early 2000s, I think, or mid-2000s. But in principle, that is what should have happened, and frankly, the fiscal as well. Again, I would say the Spaniards did it right in the sense of they taxed the housing boom quite heavily. They're today blamed for it because, well, this was all just dependent on taxing the housing boom. Well, that's what you do when you have a pro-cyclical, that's a counter-cyclical tax. So did the Irish. But in other countries like Greece, that didn't happen, and that was a problem, I think. Anybody else?
Also not a student, therefore I'm looking just around if there are other questions. I mean, it's lifelong learning, isn't it?
That's why we're all students. The older we get, the more we have to learn stuff.
Yeah, I have a question regarding the empirical evidence you just presented. Thank you first for this. I think you focused on the trade data, no? And first, I think it was just 2006, 2008, so it's quite a narrow period, the data you presented, and it's already the building up of the crisis, so the argument would be stronger if, of course, we have more data on this.
I know.
And I mean, that would be the first critique which you could expect from this. And the second point is, at the beginning you mentioned the financial crisis, the banking, and maybe to answer this question, we need also to look at this. We have no data on the degree of financialization, how the financial markets changed, were shaped by the euro in the southern, and you said it, there was a convergence of interest rates, so this is going into this direction. So maybe on the capital ownership of the banking sector, we know that in the Greek crisis, French, German banks were very important. Mm-hmm. And yeah, so the degree of financial integration could be also an explanatory variable to answer this question. Thank you.
First of all, so you're absolutely right. It would be great if we had longer data, but apparently this was extremely time intensive and went to confidential firm data. And I would defend for the point I'm making that this is at the height of the boom just before it burst, the 3-year average then. So if we see this, the North feeds on the growth of the South. We should have seen it then, when the discrepancy between the northern surpluses and the southern deficits was largest. So it is quite significant at that point. But yes, of course, it would always be good to have data over the whole period when we think that is when the euro was phased in, which was probably in the late 90s. On the second point, that will be very much my point. It is my critique of this incompatible growth regime's diagnosis that it looks only at labor markets, consumption versus investment, all that stuff, and not at finance. And in a way, and I find it quite perverse if you know the attitude of people who do that kind of literature, that in a way you blame southern trade unions for the mess that was created, because that's what you implicitly do. And I guess I don't have to elaborate why that is a nonsense. Stefan wanted to...
Thank you, Waltraud. I have a lot of sympathy with everything you have said. But I wonder, why don't you go the last mile and drop the current account argument as well? Because the current account issue is, of course, obviously important when you have different currencies, because then central banks run out of foreign exchange reserves and then you get the crisis. But with monetary union, all liquidity comes from the central bank. So the current accounts are not a monetary or liquidity issue in this. And in fact, if you can ask yourself, why is Berlin not causing a problem to, I don't know, the euro area? Because I'm sure Berlin, I don't know the data, but I'm sure Berlin is a deficit area, and nobody cares about that. Why do we care about Greece or Germany or something like that?
Yep. That is an interesting question, and I think that is why nobody saw this coming. That in a way, a crisis that can still happen if you have different jurisdictions, different supervisory arrangements that were national at the time, that it may appear as a banking crisis. And that had more to do with, or had also to do with a link between sovereign debt holding and the home bias of sovereign debt holding in banking systems. But possibly also, if you accumulate, like Spain did, for example, for a long time, double-digit current account deficits, those who hold the claims against the importers maybe predominantly Spanish banks. They don't have to be, we know that. And if we had a completely diversified financial system, or integrated, one could say, then German banks would hold these as much as Spanish banks. And if anything happens, they would share the risk through that, the hit, because when the Spanish economy then tanks, and these importers, or the banks who hold the import claims, the importers have usually paid the bill, but these banks that hold these the claims from continuous and accumulated deficits would then take a hit from several corners, and therefore are likely the ones that have a problem, that are over-indebted, and so on. And therefore, there is, if you have this integrated but not fully integrated, not fully diversified system, then you need to see where can such vulnerabilities emerge. And in the euro area, it seems to be as if the current accounts are still something that could happen. It could happen in the United States also with Nevada, that was down because it had highly concentrated debt holdings, and the economy tanked because it has Las Vegas, and nobody went, or fewer went to the casino during that time. And so that state can then also be hard hit. Or Detroit, that has for a long time a deindustrialization process with which it is. So it can happen. What is right, we don't see that as a current account problem, but in a way you could frame it in that way. And it's also just symptomatic, but not the underlying reason. I agree with you on that. But you have more integration through pension funds and so on that are all over the United States, and therefore a diffusion. I mean, to some extent, the banks in the euro area did share in the risk, except that then the ECB, of course, bailed them all out. Which is why I do also not agree with this more general diagnosis of Frieden and Stephanie Walter, that it is all a current account problem, still that old current account problem. That, yeah, we have no disagreement. Is there anybody who would like to defend the two approaches we just had? At least some of you must believe this incompatible growth. Oh, sorry, I didn't want to. Literature. Shall we get on? Okay, you can come back to any point we had. So here is my research program. I start with the fact that I say a monetary union is in a way a risk pool. The exchange, the common monetary policy makes it a risk pool. I don't look at it as an exchange rate arrangement. You abolish the exchange rate. If it's a risk pool, it's also an insurance pool, obviously. And that is, to some extent by default, target this cross-border payment system that we had. Turned out to be I think, one of the most important insurance mechanisms of which we didn't even know that it exists. And I say this is almost typical for a reason that you will understand in a minute, that helped to replace what should happen in private markets when capital suddenly stopped. Sudden stop problems that OECD countries are not used to. That happens in Brazil, but not in France. Not even in Greece it had happened like that. So, and Target was the one that was the safety valve. While everybody said, that's the problem. There you see that we have sent the printing press to Southern Europe and all that rubbish that one economist in Germany put out there. And it was sometimes by design. I had earlier mentioned free movement was thought to be a kind of mechanism through which we would adjust, but also free capital movement and so on. The central bank itself is an insurance mechanism. However, and I have to take seriously, why am I saying this? First of all, that's all not news, and I'm quite proud that I'm not saying things that I first have to explain in a big way. It should be obvious to economists that you can look at this as a currency union, as a risk pool that can be an insurance pool. But at the same time, we think of this, why do we have two theories that see diversity as a problem, ex ante? And I'm saying this has to do actually with the politics of it. So there is a paradox. The paradox of diversity, Eckhart, please put that on that list, is another paradox. The more diverse, the higher the potential insurance benefits. But also, the more difficult it is political cooperation to realize the insurance potential. We can later discuss why that is. That starts from the psychology of decision makers who think, if they don't do it like us, there must be something wrong with it, because surely we do it the right way. I analyze this all in terms of collective action problems, failures, that we even have an experience with in our own insurance experience. If you ever had a bike stolen, the insurer will try and say that you didn't lock it in the right way or something. In other words, the commitment problem of the lucky ones, of those who should insure you. It was always the moral hazard that was argument, that was the unfortunate ones were blamed for. Clearly, Greece had taken all the risk knowing that it would be so wonderfully bailed out when shit happens. Well, it wasn't. Then that was a huge miscalculation on the Greek side, and frankly, I don't think they ever thought that this would happen, because nobody thought it, so why should the Greeks know more than the rest of the world? That moral hazard argument was completely overdone, while the commitment problem of the fortunate ones was a very real one. As soon as you see that somebody is affected in your insurance pool, you should help, then you find all reasons why they deserve their bad luck and you deserve your good luck, and why you should not honor the insurance contract. So this is how I analyze the political cooperation problems in terms of collective action failure. If you say this paradox exists, and it exists everywhere, it exists between southern and northern Italy, it exists in the United States, between the states, it's not as if, if you're a nation state when we hold all hands all the time between the regions. No, you don't. Collective action failures are a fact of political economy life, and that's how I analyze them. If that is the case, then you should not observe very open, manifestations of solidarity. It can come as a byproduct, typically embodied in institutions that were created for another reason. And I take again Target. There were private cross-border payments mechanisms. Think of PayPal is one. But the ECB wanted one in which it is clear that there would be a safe and clear transmission of its monetary policy. It was a purely institutional, almost technical reasons. Deutsche Bank was lobbying as well a little bit because it didn't want to have to deal with so many payments mechanisms. And then it turns out to be an insurance mechanism against sudden stops. That is how I would expect the solution to such a paradox comes about. And we can talk later about other things that are a bit more open transfers. So there are also things that can come through national incentives. So some member state wants things, and it can turn out later to be an insurance mechanism. And therefore, I see the euro area as created for limited risk pooling. And this obsession with moral hazard is actually the evidence that they see it as a risk pool that can be abused and misused and so on and so forth. But with that accusation, you actually admit that you see it as a risk pool. In a world of unstable financial markets that are integrated through the very thing that brings it together, namely a monetary union. So there is actually a bit of a normative obligation on you to say, if we say it's a good thing for us to adopt the common currency and therefore also lead to more financial integration. If then things go wrong with all these financial crises, then we should honor that implicit insurance arrangement that's entailed in doing a monetary union that furthers financial integration. And the ERM crisis was the founding crisis, if you will, because everybody, you were too young to read the newspapers then, but we remember that it was said in all the newspapers, this was the death knell on that project with this monetary union. And no, it wasn't. It strengthened their resolve. It strengthened the resolve of member states to say we cannot be completely dictated by markets what is okay economic policy and what not. We take that out of the equation. But then when the arrangement that you have also still have these risks, well then. While I'm saying the euro area crisis was a financial crisis with a sovereign debt phase. Sovereign debt was not the cause. It was a symptom of a financial crisis. Then I have to at the same time admit that only the euro area had this diabolic loop, this loop of feedback mechanisms. In most countries that went into a crisis, so Spain, Ireland, Cyprus, it started with private debt being too high. And when suddenly banks didn't trust anymore into each other and had a bank run in wholesale markets on each other, something we had never seen before, then the feedback mechanisms came. The governments, as you know, helped banks and the economy hugely. That led to higher rising public debt, and yes, in Greece the public debt was too high. It was on an unsustainable path, but that wouldn't have rocked the boat if there were not a global financial crisis or a North Atlantic financial crisis going on at the same time. Then the risk of government bonds rises. They are downgraded, and that weakens banks' balance sheets that already have a problem even more. They try to, the fire sale of assets goes on and on. The recession deepens with huge effects on governments, and private debt rises again. That's the effect of any recession. So in order to stop this process, to either converge to a very low equilibrium or just to make it implode, you need circuit breakers. And we got some. The ECB as lender of last resort to governments only indirectly, but indirectly they did finally. The ECB, you can break that. And that was a quick thing they did, and they held it for quite a while, and arguably still to some extent. We had also the ESM, or the predecessor EFSF. Instead of Eurobonds, we created bailout funds that reinforced the view that this was just a problem of 5 countries, more or less, which it wasn't. And then, of course, they came with all these early, actually in 2009, the first thing, the single rule book, bail-in clauses in your bonds. So 8% of capital has to be, write-down has to be accepted by bank shareholders before public money can be used. And with a very limited joint resolution capacity. But it is, again, a circuit breaker, okay? The limited risk-sharing capacities have this susceptibility to these negative feedback mechanisms, and you can also see that some of it is still uninterrupted. And you could also argue that the banking union on its own, and as it originally was conceived, had only a limited capacity to break that. The ESM can do it for single countries, but if Italy would falter, it's too small. Okay, a 1.7 trillion bond market with a 500 billion bailout fund is not possible. I don't have the time to go into this excessively. I open it for discussion or questions later on. In the book, I go then into what were these implicit by-product monetary solidarity mechanisms, and I mean by monetary solidarity that it is acknowledged and at least tolerated risk sharing. As you know, the controversy around the target imbalances was such that, at least in Germany, in some quarters, it's still barely tolerated that this safety valve works without doing anybody any harm, that allows banks to upload their risks or their mistrust into the central banking system. And as long as nobody goes out of that euro area, nothing really happens. It's fine. We can have them there forever. Nobody would even know if we didn't have a central bank with diverse national central banks, and exactly the same imbalances you could see in the ISA, the target equivalent in the United States, which I also show in that book. Because this risk sharing is likely to arise for other reasons than open solidarity, that has to do with this paradox, right? That the lucky ones will never, or those who think they will be lucky in any future crisis, would not agree to it. We had that even before 2008. The collateral policy was at some point, because Willem Bouter and Seibert wrote an article in which they attacked the ECB for having this collateral policy that basically said we are not differentiating our haircuts according to whether Greece or Germany were the issuer of the bond, but it's a bond with a certain, with certain characteristics, and we treat them all alike, basically not taking a haircut. And that is a pooling off of risk, that you don't differentiate in that way. And they, for example, said they should use the SGP and differentiate accordingly and take a haircut according to those who don't, comply with the fiscal rules. After 2008, as I've already mentioned, Target, which is frankly for me the best example of them all, but also the bailout fund ESM, which was a very open act of tough love solidarity, right? I mean, I don't need to explain to you that this conditionality was extremely intrusive and punitive, and showed exactly the commitment problem of those who guarantee the bond issue that funded, and therefore the ECB had to, and the ESM had to be introduced contra Schäuble and Varoufakis, who apparently had a very good relationship while they were together in the council. Where to go from here? The whole thing is a construction site, and if my theory is right, then that's exactly how it should be. But is that all just a system that kind of does constantly piecemeal reforms and doesn't add up to very much, and so firefighting all the time, which many people think, probably you as well. So I showed you this before, and that's just a reproduction of it. We had another round of circuit breakers. There is first, the ESM has become a backstop for the resolution fund of the banking union. It added another 60 billion, which is way too small if really something happens, but it adds 60 billion to the 60 billion of the industry-financed resolution fund, and I'm sure they find a way of adding even more if need be. The ESM is at the moment in search of a role for itself, because as you may know, Italy and Spain flatly refused to take any ESM money. And because they're so big, in a way that was a threat, where they said, like Tucholsky, I think, once said, if you owe the bank 1,000 euros and can't pay, you have a problem. If you owe the bank 1,000 million and can't pay, the bank has a problem. And this was the situation of Italy and Spain. They used that very cleverly politically and said, we are not taking ESM. So they had to think about something else. And the ESM now offers itself to every other. The once proud Mr. Regling just gave an interview to a German news magazine in which, he has done a U-turn by 180 degrees. Interesting. And then this massive recovery and resilience facility ensure this really openly reinsurance mechanism for job retention schemes. So not for an unemployment scheme, but for Kurzarbeit or short-term work furlough schemes. So in a way, it's complete, but that is not my main point. My main point is that in a way what you can see in this is you can interpret this as a macroeconomic system of reinsurance. In contrast to fiscal federalism, where in a way the federal or central level and the state levels have co-insurance schemes. You know exactly what one does and what the other does in normal times and so on. A reinsurance is usually the insurance for insurers, that insurers take out, say, healthcare insurers, private healthcare insurers often take reinsurance because if medical progress means that certain expensive treatments have to be provided to policyholders, that is a huge risk to them that can actually break them because it becomes too expensive. Think of Alzheimer's or something like that, that prolongs the life expectancy of Alzheimer patients by 10 years. And so they take reinsurance from insurers that are widely diversified. The primary insurers here are, of course, the member states. They are welfare states, if you will. And reinsurance only comes into play above a certain, typically written as a certain damage that happens to you, a certain flood damage that has to be borne by the primary insurer, and then beyond this, earthquake, the reinsurance comes in. So it takes the catastrophic tail risks from the primary insurers. And this is exactly what the EU or the euro area mechanisms do. The Recovery and Resilience Fund, as you know, is one for the EU as a whole, sure as well. I would also say this, it actually acknowledges that there may be endogenous risks of monetary fiscal integration that are created by all member states. The German banks, the French banks that are often mentioned, that have had a wonderful commercial opportunities from all these housing booms in southern states, housing markets. And this is an endogenous risk where you can't just say it was the Spaniards. No, it was also Deutsche Bank. And this is acknowledged and this is taken up. Reinsurance is standalone. It can often be categorically different from the insurance that you have with the primary insurance that pays unemployment insurance. Here you can say you pay for recovery plans if that's what is your insurance mechanism, or you have SURE out of a fund. And moral hazard is inherently, that just calms down those who always think they will be lucky and need never anything. The moral hazard is inherently less of a problem because the primary insurance will have to bear the brunt of a crisis. And that makes it politically easier to go to that type of insurance rather than co-insurance. Okay? Here we can come back to it. In order to show that it is a system, I say it has 4 elements. You can say how it reinsures the primary insurers. Financial markets are an insurance mechanism, and so is sovereign public finances, for which the reinsurance was first invented. We can go through this if you're interested later. Therefore, I want to now come back to this Jean-Pierre Sani-Ferry quote. It says, the last utopia of the 20th century did not rely on a state, and Europeans decided politically to push for it. Well, my view is it isn't a utopian thing. It is an experimental thing. Because, frankly, the nation-state, and I could give you another talk about that fiscal federalism, and especially the US variant, is by no means a successful model. Reinsurance is here reinsurance as the principle of fiscal risk sharing is the principle and is the experimental principle that hasn't been used as widely as it is now in the euro area, but it makes complete sense to me. It is true that they do not rely on the state. In other words, there is not a direct complementarity between the monetary authority and the fiscal authority. And we have to try and understand why this is not by mistake oh, it's incomplete. Didn't these idiots know Peter Keynes or something like that? No, it's by design like that. Because the political integration is not there. And in a union of democracies, for a reason not there, not because Germany is Schäuble doesn't get it. He didn't get it, but that was not the reason. There is more of a problem that you have if you really want to go for a central budget. And so last, I suggest the Europeans decided to go for a common currency, but actually they were supported by initially quite skeptical central bankers and many economists and so on. And now they represent also the very diverse needs and interests in their member states, and that's exactly how it should be in a union of democracies. So that is a political choice that puts some brakes on fiscal integration. And for once, I'm with the politicians on this. We can't just move and jump into the unknown with a centralized budget when actually I don't see that the voters are there yet. I'm not even sure whether I would myself be there. Thanks. So that's what from me. So we have exactly 20 minutes if you like. Exhausted. Here's you can also tell us later what you discussed at the beginning. Yes, please.
Yes, thank you very much for your presentation. I would like to react to your last statement about what the future integration or non-further integration of the EU budget. So I wonder, you say that, of course, the EU is quite incomplete in its by design because we are a monetary union, but not a fiscal. We don't have a common budget. So you say that, and of course, the public opinion is not for pushing for more EU integration. I feel at the moment, and as you say, you yourself are not for making a common budget. So what is your view on what should we do in a way, since we are quite in an unstable situation where the EU is quite incomplete, but we don't want to go more forward. So what's your vision on it?
I do not think that the EU is incomplete, to be perfectly honest. I think it is as risk pooling is always incomplete, or insurance is always incomplete. You never get 100% insured from an insurer. That has to do typically with the moral hazard problem, because one thinks it's good that you pay for the first little damage that you inflict on your car by driving carelessly by yourself, and that this would make you not drive so carelessly. Whether that always works quite that way is another matter. But so we shouldn't be surprised. No fiscal federation has full insurance for anything you do. There is still some public, like in the United States, you have these balanced budget rules that are very strictly obeyed, because if that binds the hands of the state legislatures. They can't sign off the budget for the state governor if they don't present one. And therefore, if you then can't pay your civil servants or the pensions of your civil servants and so on, that inflicts harm on you. That's your co-payment if you don't fit with that. And in that sense, it's an incomplete insurance as well. What I think is this reinsurance mechanism is actually a good one. What one would have to fight for is, and this is what I think where the Recovery and Resilience Fund makes a bit of a difference. It is actually a preemptive insurance, if you will. It says, we will help all those who, what we can say now, even before the markets panic, will have a harder time to get out and recover. And we have it is a quite redistributive formula they have given. We help those who are poorer, and we help those who have been harder hit by the pandemic. And of course, we can then, those of us who are in favor of more insurance said this should be more generous, it should be a permanent fund, it should be this, that, and the other. So we can always talk about how much we insure. But the principle of reinsurance from the EU level is the right one, as long as we do not give up on national parliaments and the bulk of fiscal authority is with the nation, with the member states. Then you cannot go for a co-insurance principle as you have in a federal system. It would require a very different polity that we have. And thankfully we live in a union of democracies and the rule of law where you just can't dictate it from above because it would suit our economic models. I find it actually a quite authoritarian mindset to say this has to be completed because otherwise this currency can't function. Well, the currency has to function to make our living standards better. It's not that we have to adjust with everything so that the currency can survive. I mean, then if we can't, if the incomplete euro area is not functional, then let's stop it tomorrow rather than say everything has to adjust so that it survives. There's no value in it in itself. Dog wagging the tail is the word for that, no? The kind of plans that are sometimes now discussed.
Does it work? Yeah. Well, thank you for the presentation. I thought it was very interesting. I wanted to know your opinion about, well, right now as a response to the pandemic, we can argue that maybe the response is more coherent with this vocation of cooperation and solidarity and insurance. Then, of course, we can debate the extent of it. Some, as you just said, might think that it's insufficient. I'm of this opinion also. But I want to know your opinion about this second part of this, like, recovery funds, that are the conditionalities that are put on it. For example, right now in Spain is kind of a hot topic that they are discussing this labor reform that initially they wanted to tackle temporality, but now they say, but we compromise with the European Union, with the European Commission, that if we want to take the funds, then we actually have to go in the opposite direction in this labor reform. So how this, well, what you're thinking, on the one hand, there are these instruments for insurance, but on the other hand, there is this vocation of also eliminating this diversity, this thing of, you do not resemble to me, so that's your problem, and you should change that. So yeah, what's your take on that?
Yeah. So the first concern one can have with that is, of course, democratic self-determination. And the problem really comes with this resilience. I was once invited for a consultation in the EU Commission of how one should do all this. And I did notice that some of these technocrats, and I don't use it as a bad word, I have all respect for technocrats in their place, right? They emphasized the resilience and meant by that transforming structural reforms as always. And most of the experts, the academics, that there was somebody from Bruegel and so on and so forth, said, you shouldn't worry about that too much. Get the money out so that recovery can be funded. Reforms are not the first thing you think in a time when you say, at that time it was summer last year, the economies come out and have deep scars, youth unemployment, and all these things that we thought. I mean, it is also true that uncertainty was quite high and that now young people get work, but the 55-plus-year-olds in some countries don't get work anymore. So, but that is even more true. Don't use this money to micromanage the use of it. So this was very much what everybody said. Make sure that also the loan part is used, that there is really money there to stimulate these economies onto a higher equilibrium, if you will. That there will always be this temptation. However, I would warn you to think this is only then the Commission. This is usually a collusion between national politicians, and they say to them, you write that in, that we need this reform, because they for a long time wanted it or want to prevent some other reform. That should be a matter of national discussion and calling the bluff of such strategies to, visibly tie your hands and say, well, the Commission will not sign it off while they instructed them not to sign it off. As far as I know, at the operational level, the Commission is actually quite flexible. So, but the beauty of these schemes is, these recovery and resilience plans, is that you do have to have a national debate about what do we want to meet this sudden manna from heaven. And it's quite right that this happens. It's not a conditionality that's negotiated, a memorandum of understanding behind closed doors. It is an open debate, and this is how it should be. And I would, if I were you, try to say, we want to see that the Commission, we want them to say or document that this has been, imposed on us, or whether you perhaps have colluded with the Commission to make them say that, what you want, and circumvent national majorities in a representative institution. And that chance you have now. The Schelkele has been earlier there.
Well, thank you for that very, very exciting talk. I really thought it was fascinating. I agree with a lot of what you said, although I think you go a bit too far when you say it's by design and not by accident that we have this kind of insurance scheme in the euro area. I would say it was mostly by accident, and the design part is agreeing to certain part of the policies that came about by accident. I have one question concerning the target balances, because in my opinion, they're indispensable for stabilizing the euro area. They have played a very, very large role. But what you just said is the good thing about the recovery fund is that our democratic structures are actually being used, and we make decisions about what to fund and what not to fund. Target 2, in my opinion, is risk sharing taken on by the central bank and therefore by the wrong institution. It should really be taken on by policymakers. And in that sense, the euro area is unstable because we have a central bank taking on a lot of risk that should really be taken on by policymakers based on decisions made by policymakers in our democracies. And I think in that we need more risk sharing in terms of bonds rather than hidden in the balance sheets of the central bank.
First of all, Silke, I think it was really a misunderstanding. I didn't say the reinsurance system is done by design. It's actually an evolution. It was piecemeal reforms, but in a way, I'm trying to argue that there is actually a principle emerging, and that fits the reinsurance principle, but not by design. No, it was the non-complex that we don't create a budgetary union. That was not, because they haven't read Peter Keenan, who was in the OCA literature, the one who said you need something, or it would be good to have some fiscal capacity if there's an asymmetric shock. On your second point, it is absolutely true, but that is a more general point that is not confined to target, that our banking systems have become way too large, and as long as they are as big as they are, and throughout the way we have fought the crisis, the financial crisis, not the euro area crisis per se, the financial crisis, they have got bigger even. So of course there is a potential for another crisis there yet. Target is a particularly necessary element in the euro area But as long as you have capitalism, so to speak, banks are free to finance certain things and trying to find ways out of it in another way. So to me, this is not something that is specific to target. Your solution of saying, make this all openly fiscal, well, on that I would, however, warn. If that would show up in this way, this would get even more into cheap holding bonds of the Dutch and the Germans, and we let then the spreads on bonds being paid by Italy and Spain. I mean, that has real fiscal costs, while at the moment this risk sharing is an accounting thing that doesn't bother anybody except Hans-Werner von Sinnen. You do not agree? Then she should have a chance to respond to me.
I mean, again, I really think Target 2 is absolutely vital. I don't think the balances on the central bank's balance sheets, they should be eliminated or anything. But the reason we have them is because sovereign bonds of the euro area are not all high-quality, safe assets. And until we solve that problem, we'll have an unstable euro area and we'll have risk sharing through target balances on the balance sheet of the central bank. So if all sovereign debt in the euro area were considered safe assets like the German bonds, we would not have target 2 balances in the central bank.
Can we let Stefan have and anybody else who would like to come into this debate? Okay.
I don't understand your argument. I see that the quality of national bonds is a problem in the balance sheet of the central bank, but because if there's a default, then it's a loss for the central bank. But I don't understand what the link is with target. You have to explain that to me.
Well, the target balances arise because banks prefer to hold, let's put it this way. A lot of it happens because loans from the central bank, or the national central banks, are going to the southern countries. And
they prefer to hold their excess balances in the Bundesbank rather than in the whatever Cypriot central bank. But
exactly, so you have a capital export.
It may be a Cypriot bank that does exactly this. It is not that it is necessarily. And what it does have to do with the sovereign bonds, I'm really not sure. I don't think it has anything to do with it, because it may be Italian banks that use their excess liquidity and raise the excess balances that they hold in the Bundesbank. Perhaps because they think there is really no redenomination risk, because the Bundesbank will be the last one standing when something goes really wrong. I don't know why they do it. It's a big place as well. Amsterdam is now the Netherlands. The other thing I would say, even if you were right with that mechanism, that it underlying is a mistrust in the sovereign bonds. I mean, to some extent, the different quality of sovereign bonds is endogenous to how you fight the crisis. If we had said in 2010 that we will not fight this as a Greek sovereign debt crisis, but as a French and a German banking crisis, to put it starkly and to say only these two were exposed to Greece, which is not quite true, but then, and had said, let them fail, tough. That's capitalism for you. These banks have lent forever to a Greek sovereign of which everybody could know, because Eurostat didn't sign off the stability reports of Greece for ages, that they had, that their fiscal accounting was dodgy. Then at every next step, when the crisis escalated, perhaps the first time one would have trusted that Germany can kind of help that with these big bailout programs that they gave anyhow to German banks. But the second and third and fourth round, when Ireland came in which German banks were heavily involved, Spain and so on. The German bonds could suddenly have had a very bad quality because you did see their own banking system drags this proud, prudent country down. That's what I mean with the quality of bonds are themselves endogenous to how you fight a crisis. Do you treat it as a sovereign debt crisis or as a banking crisis? You have a right to...
Well, I think the big problem in 2009 through 2010 was that we did not have solidarity at that point. So if the governments had said all sovereign debts are safe bonds, this is a developed currency area, we guarantee the debt, which was proposed by France, by the way, and several other countries. Then the ECB, if the governments had just said that, then the ECB could have stepped in, could have bought as many Greek bonds as necessary, and the whole crisis would never have unfolded. We wouldn't have had the knock-on effects on Spain, which had been, I mean, let's not forget, they had fiscal surpluses in the period up to the so-called sovereign debt crisis, and suddenly they were engulfed in the sovereign debt crisis and became a failing country. So my solution is a different one. I'm not saying it should have been, they should have gone bankrupt, or quite the opposite.
Yeah.
We need more solidarity to
prevent
crises.
No, then we totally agree,
like
but
this.
I think you then underestimate this paradox that I'm talking about. That they didn't agree to buy up and commit to buying up all Greek bonds. I'm not surprised as a political economist. I mean, that would have been a very hard sell anywhere in the European Union. You have to think of solutions, and this is why Target is, in my view, such a beautiful solution. Because it doesn't require too much open solidarity, that it's politically just not very easy to do. Especially when there was all this talk about the lazy consumers in Southern Europe. But what you just said says exactly the point that I want to make. The insurance mechanisms that you can politically commit to and mobilize will decide how the quality of your sovereign bonds is. And it was deliberate that one says, if it's so, no, only we have a small security markets program at the beginning and all this, that weakened these countries inherently until the ESM came. And the ESM, I know that the Southern Europeans, and those of you who are from Spain or anywhere in this room, will say solidarity and the ESM. It was actually solidarity with the bystanders, those who were afraid of going the same way as Greece, Ireland, Cyprus, and Portugal. It protected them. It was a firewall for them. And you had to underwrite something. And we had a debt write-down for Greece, where, of course, the public creditors said, we will not take any losses, but they knew a second time they cannot say that. So to that extent, there is an exposure, was an exposure for all of them, and to that extent there was solidarity, even though it was in the end quite minimal what they had to do.
But in the end, wasn't it in 2012 Draghi who made the spreads go down and basically ended the crisis by saying the ECB would do everything necessary? And that's exactly what I just said, what they should have done 2009. So you're saying, so essentially we're leaving the ultimate rescue to an institution which shouldn't have to do it. For a couple of years, yes, we're not there yet. We haven't solved the problems of how to realize this solidarity, but we can't always have the lender of last resort taking on the risks and say, that's okay. It's not stable, and the ESM, I don't think, is quite as important in the whole scheme as
it's just, I mean, first of all, the the volumes involved would exceed the fiscal capacity even of a combined euro area, I think. The second is, why do you think the OMT worked? I'm not sure. It said you have to have an ESM program with a Troika program with conditionality before we can do all these wonderful things. And in 2015, when there was arguably with the discussion of a third bailout program in Greece, there was an opportunity to activate the OMT, and it wasn't done. Instead, we had capital controls for Greece. Why was it not? Because it's not that wonderful program that did the trick. It was the silence from Berlin that did the trick, if you ask me. That it was not objected to. This kind of, giving that guarantee. And of course, it was agreed before at the Council with 4 countries in the room, and not the Commission: Spain, Italy, France, and Germany. And he asked for agreement to make this announcement before he asked his own governing board. That is documented in the FT if you want to read it, and I've heard it from somebody who was there. So that was it. It was a purely political mechanism. This program does nothing to stem anything, because you first need an ESM program that Spain and Italy just now said, we will never take a program that treats us like second-class citizens. And therefore, I'm afraid Super Mario was not, he saw the political, it was not the central bank, it was the politician who had the right signal there to markets. And it was later that it was not objected to by Germany and the Netherlands and so on, I think. Oh, we are over time already.
We are 5 minutes.
You're
I don't know if we open the floor for one last question, or if we have the.
Or we go for coffee and
discuss
that. Thank you all very much.
Yes.